Today, Bitcoin sinks sharply as investors take profits from an early December rally. Stablecoin issuer Tether tightens its rules around sanctioned crypto wallets, and Anthony Pompliano of Pomp Investments explains why he believes Bitcoin's bull run has just begun. Welcome to CNBC's Crypto World. I'm Jordan Smith. Crypto prices in the red to start the week, with Bitcoin dropping more than 4.5% to around $41,780 as of noon Eastern. Bitcoin hit the $41,000 level about 1 week after the cryptocurrency hit a new high for the year of more than $44,000. Ether dropped around 5.5%, but still traded above $2,200, and Solana fell nearly 4%. All right, let's talk a bit more about what's driving the sell-off in the crypto market. Bitcoin dipped as low as 40K over the weekend as investors look to take profits from the sharp run-up we've seen in recent weeks. The sudden drawdown forced $120 million in long liquidations for Bitcoin and $80 million in liquidations for Ether, as pointed out by Crypto World's Tanay McKeel on CNBC.com. These latest declines come after a 12% rally for Bitcoin to kick off December, and those gains, of course, largely stemmed from hype around potential approval of spot ETFs. Galaxy Digital says those ETFs could reach a $14 trillion addressable market in their first year. Now, that upswing may have started with Bitcoin, but as crypto rallies often do, investors quickly branched out to other major altcoins and drove prices higher. Prices might be coming back down today, but experts aren't sure this pullback will last. Wolf Research's Rob Ginsberg says Bitcoin remains red hot and is trading at a pace not seen since 2021. Upcoming catalysts are, of course, the ETFs, as I mentioned, but also a few others we'll talk about in our main story in just a moment. You can get even more insight on today's sell-off by going to cnbc.com/cryptoworld. All right, here's some other stories you should know about. Customers are pulling hundreds of millions of dollars from crypto exchange HTX following a hack. That exchange, formerly known as Wobi, suffered a $30 million hack back on November 22nd, and data from DeFi Llama shows more than $250 million has been pulled from the exchange since it resumed operations back on November 25th. Now, in the wake of that hack, HTX advisor Justin Sun posted on X that all funds on the crypto exchange were secure. Next, stablecoin issuer Tether has stepped up its policies to combat sanctions violations. In a weekend blog post, the company said it was starting a new voluntary wallet freezing policy for activity connected with sanctioned persons on the OFAC specifically designated nationals list. Tether CEO Paolo Ardoino said the move would strengthen the positive usage of stablecoin technology and make a safer stablecoin ecosystem. CoinDesk reported that on-chain data showed around 40 wallets had been frozen as part of the new policy. Back in October, the Wall Street Journal reported that Tether was allegedly used by Hamas, North Korea, and sanctioned Russians. All right, back to prices for our main story. Crypto World's Talia Kaplan sat down with Pomp Investments founder Anthony Pompliano last week about what's been fueling Bitcoin's rise to new highs for the year and what we can expect from crypto in 2024.
For months, we saw Bitcoin trade in a tight range, unable to surpass the $32,000 level. And now we're seeing Bitcoin hit fresh highs for the year, surpassing $44,000. So what's changed?
Well, obviously price goes up because there's more buyers and sellers in the market. And so the question becomes, why are people buying Bitcoin? And I think that it's a confluence of things. First of all, there's speculation around the Bitcoin ETF. As we get closer and closer to these kind of early January dates, I think people are just saying, look, there's higher probability that it's going to get approved. And if it gets approved, they believe the price is going to go up. So they want to own it before the approval. And, pretty self-explanatory. Then if you go and you look at things in the macro environment, markets are forward-looking. And so what people are anticipating is someone may say to themselves, okay, if we've had this kind of quantitative tightening, we've had interest rates rise at the fastest rate in history, we've been selling off assets off of the Federal Reserve's balance sheet, that's going to change at some point, right? If they continue to keep the economy tight, they're going to push us into a recession. And so when there is a return to quantitative easing, the thought process is that many assets, including Bitcoin, will rise very rapidly. And so you don't wait for them to return to loose monetary policy and then buy the assets. You want to buy it right before they return. And if you go and you look, Bill Ackman has this bet that he thinks interest rates are going to cut in Q1. The market is pricing in 100% probability of an interest rate cut by the end of Q2. I think there's a lot of folks who just say, look, I'm not going to wait. I'm just going to go ahead and start buying now. And so that's providing some pressure. There's a third thing that I think is pretty interesting. I recently was talking to somebody over at CoinFund, David Pacman, who leads their investment team. And he showed me a chart that essentially there's been 3 major crypto exchange CEOs who have left or quit or been fired from their role. We have Arthur Hayes, we have Sam Bankman-Fried, and then we have CZ. After every single one of those, the market rallied pretty aggressively very shortly after. And the thought process being that whether it is perceived risk or actual risk, the market enjoys certainty. And so whenever there is some degree of certainty that's brought into the market, then people will allocate capital and obviously the price will go up. And so regardless of kind of what the actual reason for the price going up, I don't think you can point at one thing, but what we do see is that capital is flowing into the market. When you add in the fact that 70% of all Bitcoin circulation hasn't moved in a year, illiquid market, capital flowing in, price has to go up to accommodate everyone. And I think that it's only getting started right now.
So do you think the positive momentum will continue into 2024? Do you think we'll continue to see this rally?
Yeah, I mean, my message right now and why I've been doing so much media is just to explain to people, look, Bitcoin's bull market has begun. And when you look at these market cycles, historically, they've been kind of 4-year market cycles in between these Bitcoin halvings. And so usually what will end up happening is you'll get about 2.5 to 3 years from the bottom of the last bear market to the top of the next bull market. And then you'll get about a year and a half market correction. And so historically, that has been hundreds of percent up, and then you get about an 80% drawdown. Now, the next bull market and bear market, I don't know if it's hundreds of percent or tens of percent. I don't know if the drawdown is 30% or 80%, but definitely it is a very strong indicator that we now have bottomed out of the last bear market. The bull market has begun. And the question now on everyone's mind is, how high will Bitcoin go in this bull market?
Speaking of the halving, Bernstein recently put out a report saying that it expects Bitcoin miners will outperform the broader market going forward, thanks in large part to the Bitcoin halving. Do you see that happening?
Well, right now, if we just look at 2023, so year to date, the S&P is up about 19%. The leading miners are all up somewhere between 250 and 300%. And so if you look at Bitcoin's performance, Bitcoin's up about 150 to 160% depending on the day. And so the miners are outperforming in many cases, sometimes as much as 2x Bitcoin's price. And so you got to ask yourself, well, why is that happening? And we've seen this debate before. The gold community has long debated, should you buy spot gold or physical gold, or should you be buying these cash flowing gold mining businesses? Now, they have different risk reward profiles, but what we're seeing when it comes to Bitcoin miners is in 2023, they have been the better asset to have allocated to. Now, the question becomes, will that remain over a long period of time? The beauty of the Bitcoin community is many people are not speculating in the short term. They simply want a simple asset that they can dollar cost average into over time and hold it for years, if not decades. That's much easier to do with a commodity like Bitcoin than it is with a cash flowing business that has a management team. They've got to navigate different market cycles. They've got to manage debt, etc. And so it all comes down to what the risk return profile you're looking for is. But so far, the miners are outperforming.
Data from S3 Partners shows that short sellers lost more than $6 billion in crypto-related bets, with half of those losses coming from Coinbase shorts. What does that signal to you?
Shorting a market that can go asymmetric very quickly is usually not a good idea. And if you look at short selling generally across the market, right, in traditional finance, there's short sellers that have been doing this for a very long time. They're either shutting down their firms, they're returning capital, or you have a lot of long short funds that are saying, look, we're just not going to short individual names anymore. There's just too much unpredictability, too much chaos. And so it just doesn't make sense from a risk reward standpoint. Well, that is all put on steroids in the crypto market, right? If you're not willing to short, let's say, an S&P 500 company, what are you doing shorting a company that can go up hundreds of percent? Coinbase specifically is up like 330 or 340% year to date. So if you're willing to short something that can go up 300, 400% in a given year, then you really better make sure you're right. And so what we've historically seen is just humans are really bad at market timing. And being long and something going down, at least you have the ability to kind of hold it for long enough for the market to come back. If you're short and it goes against you, you can lose a lot of money very quickly. And I think what you're ultimately seeing is not just in crypto, but across the market of finance, many people are just saying, look, shorting is not worth it. And I think crypto is kind of the cherry on top, that they're just blowing out these shorts and saying, look, understand what the fundamentals are, get long, and just be passive. And that's probably going to be a better strategy.
Speaking on Capitol Hill, JP Morgan CEO Jamie Dimon said that if he was in the government, he would shut down crypto. What was your reaction to that?
Jamie Dimon is probably one of the best bank CEOs in history. He's built an amazing business. I don't think anyone who understands, kind of banking and finance can look at it and say that Jamie Dimon doesn't know what he's talking about. On this specific topic, though, I think that there is a little bit of what is being said, and then if you look at the actions of the bank, there's different actions, right? And so, one, when you're in these hearings, obviously you're speaking to a certain audience. And when you're speaking to politicians, when you're speaking in front of the national media, there are expectations of the leadership of large financial organizations or large banks. And I think Jamie was probably addressing some of the questions from that perspective. But the bank has a blockchain team. They have hundreds of people that are working there. They forever have been building out things like stablecoins, et cetera. On top of that, I think that there is kind of a tale of two tapes, because you also have large financial organizations like BlackRock, where Larry Fink is going on national television and he's saying, look, when people are buying Bitcoin, it's a flight to quality. And so really, I think you got to ask yourself, well, what's the incentive here? And if you were to ask kind of people across Wall Street, who is most likely to lose market share or lose out something if these assets and these technologies become viable, it's the banks, right? It's not the asset managers. The asset managers are pretty nimble. They're able to say, okay, I can create an ETF for stocks. I can create an ETF for Bitcoin. I just simply switch out the underlying asset and it's the same ETF wrapper. I can raise private funds and allocate capital. And so I can go ahead and adapt to change much more easily than, let's say, a bank where part of my business model is based on transaction fees or other types of kind of revenue streams that directly compete now with this new technology that appears to be much more advantageous. And so, look, you can put a lot of weight on the words that are said in these hearings, or you can put no weight on. I tend to not really pay attention to what any one person is saying in the hearings. I really just go and look at their organizations and what are the actions they're taking. And so my guess is that it was well received by the audience he was speaking to. At the same time, there's a lot of people who went to work today at JP Morgan. They're going to go work on blockchain technology. And so just understand the difference between those two things is important.
Pompliano also weighs in on the performance of altcoins this year. You'll be able to check out his full interview over at cnbc.com/cryptoworld. All right, that's all for today. We'll be back again tomorrow, and we'll see you then.